Okay. Good evening to one and all. I would firstly like to take the opportunity to thank WRC for this, for allowing me to share my thoughts on this very important topic of disclosures and significant accounting policy. I would also like to thank Jeenal ma'am and Ketan Sayya sir for giving me this opportunity to speak. Now, the topic that we have in hand today is disclosures, significant accounting policies, notes to accounts, and FRRB conversations, observations. Now, if we notice, we are running a little bit behind time, so we will try to cover as much as possible. Couple of things. Disclosures includes two things. One is the significant accounting policies which every company has to present along with the financial statements. And second, the notes to accounts, which are the notes which are followed by the P&L notes or balance sheet notes, etc. Along with that, certain things we will see how, what kind of observations FRRB has come out with for AS as well as Ind AS compliant balance sheet. So we will be doing both. And like the previous speaker Chintan Bhai said, that FRRB observation is something which is very critical, which is a serious document which can help us learn from other person's mistakes. You know, when I was studying for CA Inter, my accounts professor used to say, a wise person is someone who learns from his own mistakes, but a wiser person is someone who learns from others' mistakes. So if we have a document like FRRB observations and QRB observations, I think we should use that document to ensure that we don't make such kind of mistakes. Before we start, just wanted to understand first to highlight that there are various sources from where disclosures of companies have been prescribed. Disclosures of companies is not limited only to Companies Act. It's not limited only to Schedule 3, that only jo bhi Schedule 3 mein likha hua hai, all that you have to present. Even beyond that, there are other disclosures which can emanate from the accounting standards or the Ind AS itself. Even beyond that, there are other regulations which prescribe some or the other disclosures which every company has to give. So firstly, like we said, Companies Act 2013, which would include your Schedule 3 Division 1 as well as Division 2 and the rules. So the disclosure can come from there. Other than that, the disclosure can also come from accounting standards, Ind ASs. Different accounting standards will have different disclosures with respect to that particular accounting standard, with respect to that particular Ind AS. SEBI LODR regulations can additionally prescribe certain items to be disclosed in the financial statements or even as part of interim financial statements. Further, if you are a entity like a bank or an NBFC which is governed by RBI, some asset classification, etc., which comes from RBI regulations, IRDA regulations, and over and above that, ICI guidance notes and all are always there. Sometimes, very rarely, but sometimes, even some other acts and regulation prescribe some additional disclosures which are supposed to be given. For example, very basic example, MSME disclosure. Today, why do we make a disclosure pertaining to MSME? Because as per MSME Act, every company has to disclose. So, moving on and coming to our agenda very quickly. First, we've understood the sources of disclosures, where all the disclosures are prescribed for a financial statement of a company. Next, when we talk about disclosures, it is very important to understand what is a small and medium-sized company and what is a small company. We will understand that in detail. Next, we will also understand certain disclosures, certain disclosure requirements which come from Companies Act itself. I know tomorrow you all have a session on the Schedule 3 disclosures. So this part we will not do very much in detail, but some important disclosures we will take up. Next, we will understand, we will take up few accounting standards, few important accounting standards and few important Ind ASs where QRB or FRRB has come out with, has found major deficiencies in those Ind ASs. Of course, in a span of 2 hours also, we cannot cover all accounting standards, all deficiencies, so many deficiencies are there. So we will try to cover the major accounting standards. And When we are covering that, we will also see practically what accounting policies are disclosed, what are good accounting policies, what are the disclosures which are prescribed as per the standard, and the FRRB observations pertaining to that. And lastly, we will also see disclosures coming from other acts as applicable to companies. Okay. First, before we start, coming to the first point, SMC versus small company. Can anyone help me understand the difference between small and medium-sized company and small company, and where these definitions are coming from? Anyone? I know it is the last session of the day, and which one? Small companies under Companies Act. And SMC? Okay, but not for us. If it is in MSME Act, then why is it applicable to us for companies' disclosures? The SMC definition, which is small and medium-sized company, comes from accounting standard rules, which is prescribed by ICAI. Small company is a definition which is given in Companies Act, which is very clear. But small and medium-sized company, that definition is given by ICAI accounting standard rules, which give certain exemptions for companies who are small and medium-sized companies. Now, those exemptions can be from following a particular accounting standard, or exemptions from disclosure requirement of a particular standard, or doing some doing some accounting procedure in itself. So, let us understand first what is the difference between SMC and small company. SMC means a company whose debts or securities or equity or debt securities are not listed and not in the process of being listed, either in India or outside India. Second, it is not a bank, financial institution, or insurance company. Its turnover does not exceed 250 crore in the immediately preceding year. Its borrowings, including public deposit, do not exceed 50 crore at any point of time during the previous year. And last but most important, which is not a holding or a subsidiary company of a company which is not an SMC. Again, this definition has nothing to do with Companies Act. Companies Act definition of small company is different. This is the small and medium-sized company as per accounting standard rules, where accounting standard rules says that if a company is a small and medium-sized company, it has certain exemptions which it can avail and not disclose additional things which are required to be disclosed. So, and the last one is very important, which is not a holding or a subsidiary company of a company which is not an SMC. Many times what happens is we end up looking at our company only, and we forget that who is our holding company, do we have a subsidiary company, etc., and we don't look at their criteria. So in fact, in one of the FRRB observations, you will see that it was a small company, but it was a holding or a subsidiary of a company which was not a small company. So automatically that company was not a small company, but the company had taken the exemption and not prepared cash flow statements. So that is where this particular distinction will come. To understand a little bit further of SMC, qualification for exemption or relaxation, an existing company which was previously not a small company subsequently becomes a small and medium-sized company shall not be qualified for exemption in respect of accounting standards until the company remains an SMC for 2 consecutive accounting periods. So this talks about a situation where earlier the company was not an SMC. It was a big company, the turnover was more than 250 crores, because of which it is not an SMC. Now in the current year, the turnover has reduced, because of which it is an SMC. But just because in the first year, the turnover has reduced and now the company is not an SMC, you cannot avail the exemptions directly. You have to wait till the company is an SMC for 2 consecutive periods. And then only you can avail the exemptions for SMC. What are the exemptions also? We will see, don't worry. Then, at the SMC which does not disclose certain information pursuant to exemptions shall disclose by way of a note that the company is a small and medium-sized company as defined in accounting standards rules. Accordingly, the company has complied with accounting standards as applicable to small and medium-sized companies. Again, of course, see, if you are a company which is governed under, which is preparing its financial statements under Ind AS, this is not applicable. This is only for those companies which prepares its financial statements under accounting standards. If you are a SMC company who's taking some exemptions or taking some relaxations, then you have to disclose the fact in the financial statements. Generally, we disclose this in note number 2, basis of preparation under significant accounting policies. A company was an SMC but no longer qualifies for exemption, then relevant standard become applicable from the current year itself, and you can give a note in the financial statement that since the company is now no longer an SMC, all the standards are applicable now, but comparative if information is not given because last year it was an SMC. So that thing is there. So if you look at it this way, it was not an SMC but now becomes SMC. Then you have to wait for 1 more year for claiming the exemption. 2 years you wait and then you can take exemption. But earlier it was an SMC, now it is not an SMC. You don't have the privilege that you can wait for 2 years for it not to be SMC and then let go of the exemptions. From the current year itself, you have to follow the accounting standards in its entirety. Okay. That was SMC. SMC is as per accounting standards rules, because of which you may not follow some or the other accounting standards. Definition of small company. Small company is governed under section 2 subsection 85 of Companies Act, which is a company other than a public company whose paid up share capital does not exceed 4 crores and turnover does not exceed 40 crores in the last year. Provided that nothing shall apply to a holding or a subsidiary company registered under section 8 or company or body corporate by any special act. So this is the definition of small company. Benefits that a small company has. Now we are not talking about the benefits that an SMC has. SMC is as per accounting standards, so some accounting standards that SMC may not comply. These are the benefits that a small company has by definition of Companies Act. They don't have a need to prepare cash flow statement. Advantage of preparing and filing abridged annual return. This is for MCA perspective. Mandatory rotation not required. Auditor of small company is not required to reporting on internal financial controls. Holding of only 2 board meetings, a small company can hold only 2 board meetings, and CARO is not applicable. By definition of CARO 2020 is not applicable to a small company. Can there be a situation where the company is not a small company, but the company is an SMC? Yes? Does it anywhere say in the SMC definition that a public company cannot be an SMC? Not listed, just public. If the company is a public company and does not satisfy any of these criteria, can it still be an SMC? Yes. But by definition, can a public company be a small company? No, because definition of small company itself excludes public companies. Alright, so we have to be very careful when we are taking on these exemptions. You have to be very sure who is your holding company, who is your subsidiary company, etc. Okay. This we understood the exemptions for a small company as per Companies Act. These are the exemptions or relaxation for SMC as defined in the ICAI accounting standard rules. AS 17 segment reporting in full is not applicable to an SMC. AS 15 employee benefits, the company may not recognize recognition and measurement of short-term accumulated compensated absences which are not vesting. We will understand this in detail in the coming slides. Is not applicable. And additional discounting of amounts for more than 12 months is not applicable, and some presentation disclosure is also not applicable. So the small and medium-sized company can do away with all these things. And AS 19, some additional disclosures are not applicable to them. They can take the exemption. Okay. Any questions till now? We have just understood the difference between SMC and small company. Small company is governed by Companies Act. SMC is governed by accounting standard rules. Small company, because it is governed by Companies Act, just we can link it in such a way that whatever Companies Act requirements are there, those might be exempt. SMC governed by accounting standard rules. Whatever accounting standard disclosures or requirements might be there, might be exempt to SMC. Okay. Coming to disclosure requirements which are there in Companies Act, again, like I said, we will not be taking up all the disclosures in Companies Act because you specifically have a session tomorrow for Schedule 3 disclosures, but we'll take up few amendments which had recently come. In the general instructions of Schedule 3, again, this is both Division 1 and Division 2. As per the old Schedule 3, depending upon the turnover, the figures appearing in the financial statement, it said may be rounded off. And if the turnover was less than 100 crore, the rounding off was so-and-so, 100 crores or more, rounding off was so-and-so. But that was an option given to companies earlier. After the amendment, which came, I think, 4 years ago, 3 years ago, which the amendment came, depending upon the total income of the company, the figures appearing in the financial statements shall be rounded off. So there is a clear change of word and clear intention that depending upon the turnover, you have to round off the financial statements. Earlier it was an option. Now it is no longer an option. And when I say now, at least for the last 3 years, there is no longer an option to give financials in full figures. Yet you will see the latest report which is given by FRRB for the third report which was given by FRRB for Ind AS non-compliances. They saw financial statements which were not rounded off. Yes. So earlier it was turnover, now it has become total income. Total income is revenue from operation plus other income. That way. Okay. So now rounding off is mandatory. Additional disclosures which was prescribed by those rules again said that you had to give the shares which were held by promoters at the end of the year. Can anyone help me? What were the various types of disclosures which any company had to give for the share capital? One, we had to give authorized, issued, paid up. 5%. More than 5%, yes. Reconciliation, opening, shares issued, buyback, closing. Then, whenever a company had ultimate parent company or a parent company or a holding company, shares held by holding company, ultimate parent company, etc. That is a different disclosure than more than 5%. Huh? Both are different disclosures. So in more than 5%, all companies may not come. But if a company has two holding company, one is the holding company and one company owns 0.01%. In the shares held by holding company and others, that also has to come 0.01%. Further, there was one more disclosure that the company has not undertaken or company has undertaken buyback, etc. in the last 5 years. And then they added this shareholding by the promoters of a company. And then of course, what is the change in promoter shareholding compared to the last year? So this disclosure has been added. Okay, now when we talk about promoter has defined under Companies Act itself because this is Companies Act disclosures. Trade payables and trade receivables, they had come out with aging schedule, which I believe everyone is aware of. That very simple, you have to give aging. Aging has to be from the due date. I'll just run through this. Aging will be from the due date, not from the bill date. Okay. Similarly, capital work in progress. For capital work in progress also, projects which are in progress, projects temporarily suspended, you have to give aging schedule for how long the projects are in progress, and if they are suspended, for how long it is. There was a confusion, it has to be project wise or it has to be totality. The company can take a call on totality, it can give it. And if required, if the company wants to give more detail, then project wise also they can give. But project wise is mandatory if the project is overdue. The project was supposed to be completed, project is not yet completed, then project wise we have to give. Okay. Trade receivables, like I said, aging is there definitely into various sections, but that does not mean that the old requirement has been removed. The old requirement for trade receivables was that all the trade receivables had to be classified as considered good, secured, considered good, unsecured, considered doubtful. This requirement has not been removed from Schedule 3. So this requirement is there, plus you have to give the aging. Okay, so if this requirement, you are not making it as a part of your aging, separately in the note of trade receivable, you have to still give this. And sometimes what happens, a company has unbilled revenue at times. So what we do is, after this total out here, we just add unbilled revenue and write the amount of unbilled revenue, which is separately linked from the note. So that way you can do that. Next disclosure, additional disclosure comes from CSR section 135 of Companies Act. CSR has various disclosures if a company has an ongoing project or if a company does not have an ongoing project. Either way, the company has to disclose on CSR regulations whenever CSR is applicable to the company. So, and this is just theoretical, I'll show you in the disclosure form so it's easier. This is the disclosure for a company where it is the company has donated to other than ongoing projects. So whenever a company has donated to other than ongoing project, the amount which was required to be spent by the company and the amount actually spent by the company both has to be given for current year as well as previous year. And on what activities has the company spent, on construction or other than construction. And if it is other than construction acquisition of assets, then you have to disclose specifically where it has spent. Further, you have to give if there are any related party transactions and if any provision is created during the year. Generally, provision may be created if you've not spent up to 31st March, but you just created a provision and subsequently by April you have spent it. This is for those CSR activity disclosures where it is not an ongoing project. But if the project is an ongoing project, you have to give all these 8 disclosures, my mistake. Amount required to be spent, amount spent, shortfall at the end of the year, and total of previous year shortfall. You have to give reason of shortfall. The reason of shortfall can be that it is for an ongoing project. So as per the CSR regulation, because it is an ongoing project, you have 3 years to make the spends. Correct? Since you have 3 years, there can be a shortfall in year 1, but ultimately up to 3 years it has to be spent. Then you have to give the nature of CSR activities and details of related party transactions and liability income, if any. So these are the disclosures for CSR. Ratios, again, I will just run through the ratios. Ratios has come since a long time. All these ratios are mandatory and deviations have to be given if there is a, reason has to be given if there is a deviation from current and last year of more than 25%. Just from personal experience, I would suggest whenever you all are signing the balance sheet, whenever you are looking at the balance sheet, please look at the reasons which are given and whether they have been given properly. What happens is the client prepares the financial statement, client half of the time understands, half of the time does not understand. Our articles look at it, they also half of the time understand, half of the time don't understand. Yesterday it happened that the net profit had increased in the current year and that EBIT ratio, they said because of reduction in EBIT, it has gone up. So just look at the reasons. The reasons cannot be different from what the ratios have, what has actually happened. Okay. Cryptocurrency, again, if your company is dealing in cryptocurrency, then these disclosures are required. As of now, it is not much of a reality, but moving forward, considering what is happening with the tariffs and everything, we don't know. Cryptocurrency might become the future currency where most of the companies deal with. Okay. Those were the basic disclosures in the, as per the schedule 3. You will get a detailed flavor of disclosures tomorrow in tomorrow's session. Taking up important accounting or accounting standards and Ind ASs. Let us understand let us have a look at the deficiencies which were observed by FRRB. These were the non-compliances, all Ind AS wise, where they've observed major non-compliances. I have not prepared this. It was already there in FRRB report. मैंने से उधर से screenshot लिया. Same, when they did a study of accounting standards, they identified percentage-wise where the majority of non-compliances were there. If you just check, the number is different, but it pertains to the similar accounting standards. Major disclosures come in AS1, Ind AS 1, which is accounting policies, in AS 15, Ind AS 24 on employee benefits, in accounting standards on taxes, AS 22, Ind AS 12, and related party transactions. So these are the 4 major places, and cash flow statement. I still don't understand why cash flow statement, everyone makes mistake. Even I make mistake. My things also go for review with partner, and every time he changes cash flow statement. So cash flow statement also major deviations. Okay. Before we understand go ahead in detail on each particular accounting standard Ind AS, major ones. First, let us understand, since the last 2 years, there has been a change in Ind AS. It is not significant accounting policies anymore. You have to disclose material, you have to disclose material accounting policies and other accounting policies. So now in the financial statement, you have to bifurcate the accounting policies between material and other accounting policies. This change has happened since the last year, last to last year, and now that segregation has to happen in the financial statement. Again, this is only for the companies who are preparing financial statements in Ind AS framework, not in accounting standard framework. As per Ind AS, material accounting policies are those policies which are significant to the user's understanding, and non-material are those policies which are trivial, generic, or have no impact on user decisions. Example of material could be revenue, impairment, leases, etc. Non-material could be rounded off, prepared in accordance with Ind AS, etc. But this does not mean that you don't give such policies. You give such policies, but you have to segregate between material and other accounting policies. Okay. Guidance is also provided in ICI guidance note. Only those accounting policies that are significant and relevant to the user's understanding shall be disclosed. Entity should avoid a long list of standard or boilerplate policies. Now this bifurcation was made after Ind AS got notified, where they said that now you have to distinguish between material and others. FRRB observations, if you see, it said that many companies were giving generic non-material accounting policies. FRRB had advised restricting only to material accounting policies. Okay. Coming to the first accounting, any question up till here? If I'm going a little bit fast, you can please tell me. Any questions? We can take it up. Great. Coming to the first accounting standard which I want to take, AS 15 and AS 19. The major difference between AS 15 and Ind AS 19 is that when the P&L impact, statement of profit and loss impact comes in the Ind AS, it gets bifurcated into the profit and loss, income and expenditure, and the other comprehensive income. Correct? But and what goes in the other comprehensive income is nothing but the actual gains and losses because of past adjustments. So that is the major point of difference between AS and Ind AS. Otherwise, more or less everything remains standard. I'll just spend 2-3 minutes on the theoretical part of AS 15, where the definition is same in Ind AS, and we can then understand first in accounting standard where you have to do actual valuation, where actual valuation is not required, where you have to do provision, where provision is not required. And then we can come to the accounting policies and FRRB observations pertaining to this. Short-term employee benefits. Short-term employee benefits are those employee benefits which are payable within the next 12 months, not long-term, nothing to be done. Post-employment benefits can be gratuity, pension, other retirement benefits, etc. Other long-term benefits could be long service leave, other long service benefits, long-term disability. It is not restricted, other long-term benefits is not restricted only to leave. It can also be your long-term bonus. Many companies have a policy to pay bonus to employees if the employees stay in the company for a long period of time, and they call it some long-term incentive plan. Other companies can have share-based payments. Share-based payments also fall under other long-term employee benefits, not post-employment, because share-based payment, the criteria is not that the employee leaves the organization after employment, it can be even before. So it falls in other long-term and termination benefits. Post-employment benefits, again, employee benefits which are payable after the completion of the employment. Then major difference comes in defined contribution and defined benefit plans. Defined contribution means the company every month or every year or whatever has to give a defined contribution, fixed amount of contribution. Defined benefit is defined, amount may vary. In defined contribution, once the employer puts in the money in the plan, the risk is not of the employer. Example, provident fund. When the employers put money in the provident fund, the risk of that fund working, if the fund goes into zero, liquidation, the risk is not of the employer because the employer has already given the money. In case of a gratuity fund, where the employee employer is transferring some money to the gratuity fund. If the fund does not perform, still the responsibility is of the employer to ensure that the liability of the employee is met in terms of provision for gratuity. So that is the major distinction between defined contribution plan and defined benefit plans. And for both, you have to give an accounting policy as well in the financials. This is just a short table that I have prepared. What are the types of benefits, where provision is required, where actual valuation is required, where detailed disclosures are required. Let us take one by one. We can go slowly out here. Short-term employee benefits, provident fund, etc. Provision is required if you have not paid as on March. Yes. As per actual valuation, not required. Why? Because it is short-term. Actual valuation would come only when the liability exceeds 12 months. So, and no detailed disclosure, but disclosure is required, but not detailed disclosures. Post-employment, let us take example of gratuity. Okay. Now, this distinction which is there out here, SMC, non-SMC, this is only for those companies which are not following Ind AS. If a company is following Ind AS, actual valuation is mandatory. So there is no exemption on that. But this is for those companies which are not following Ind AS, which are only doing accounting standards. In that SMC, non-SMC, there is a distinction. If the company is an SMC, it's a small and medium sized company, are you supposed to create provision? Yes. But up to 50 employees, provision can be created on arithmetic basis. It is not compulsory to do actual valuation. But what is the criteria for that? The company has to be an SMC and the number of employees has to be less than 50. If that is the case, does the AS say that you don't create a provision? No. You still create a provision, but it need not be on actual valuation. It can be on an arithmetic basis, calculation, management calculation. Same way for other long term, which includes leaves, leave encashment, leave entitlement. If it is an SMC with up to 50 employees, provision can be made on arithmetic basis. But if it is an SMC with more than 50 employees, actual valuation required. If it is not an SMC, actual valuation required, mandatory. Is it necessary that the employee has to complete 5 years and only then you will create provision for gratuity? No. The liability gets accrued from the time that you are receiving the service. So, it is not that only after the employee finishes 5 years of service, you will start creating provision for gratuity. What happens then in your profit and loss account? Last 5 years ka provision, you're putting it in 1 year P&L. Not comparable at all. So it has to be created right from when the employee starts giving service. Unless provision for gratuity act is not applicable to you only and you are not going to give also. See, two things. One, POGA may be applicable, may not be applicable because you have less than 10 employees or whatever. Second, even if POGA is not applicable, payment of gratuity act, you as a company may have a policy to still make payment of gratuity. Even at that point of time, you have to do this, creation of liability. Okay? Okay. Detailed disclosures are required for non-SMCs. For if you are an SMC, doesn't matter how many employees, detailed disclosure is not required. But if you are a non-SMC, then detailed disclosures are required. Okay. This was for gratuity. Let us understand compensated absences. Before we understand this particular chart, if the employee can carry forward the leaves, just an example I'm giving, if the employee can carry forward the leaves, but the employee cannot encash, it can only be carried forward and used as leave. Do you need to create provision for this? Yes. Any other alternative answer? No, only second alternative. Anyone who says no, don't need to create. Let us understand. Compensated absences are of two types: accumulating, non-accumulating. What do we mean by non-accumulating? What my CA firm has. Whatever is your closing leave balance, you cannot carry forward. Closing leave balance अगर तुम्हारा ज़्यादा है, lapse हो गया, खत्म. Nothing can be carried forward. That is non-accumulating. Accumulating means whatever, if I have a closing leave balance, it can be carried forward to the next year. Up to a threshold. We have a threshold, yes. So up to a threshold, it can be, I can encash it. Otherwise, it gets lapsed. So non-accumulating means no carry forward. Accumulating means carry forward. That carry forward may be threshold, may not be a threshold, whatever, depending upon company policy. Even if the leave compensated absences are accumulating, there are two types. They could be vesting, which means you have to pay cash. They could be non-vesting, which means no need to pay cash. So how will the employee utilize the leave balance if he cannot encash it? He can take that leave in the next year. Very simple. If it is vesting and short term, then there is no need for actuarial valuation, because actuarial valuation means projected unit cost method, which means that the actuary will determine the actual liability at the point of time when the employee will retire or will leave the company, and then he will discount that liability to present value as on today. So actuarial valuation comes only if the liability is for more than 12 months. So if it is short term, let's say for example, the employee can carry forward the leave, but has to utilize the leave in the next 6 months, after which the leaves lapse. This is a short term leave. Correct. So your actuarial valuation is not required because it is short term. But if it is long term, where the employee can encash it on retirement or whatever, actuarial valuation is required. This is for vesting. For non-vesting, if you see, there is no difference in the accounting standard. Even if the leaves are non-vesting, which means the employee will not be paid cash, whether he leaves or he remains in the company, employee will not be paid cash. If it is short term, obviously no actuarial valuation, but if it is long term, actuarial valuation is required, and you have to create provision also. Many times we have seen that, and in fact, especially this argument will come from the companies to say that, but we are not paying anything to the हम employees को कुछ दे नहीं रहे तो हम लोग create क्यों करें provision? Because accounting standard does not distinguish. Then it is not provision for leave encashment, but it is provision for leave entitlement. And the explanation to that is, let's say for example, I have 5 leaves unutilized, which I'm carrying forward to the next year. In the next year, I can take those 5 days extra leave, but my salary component will not be deducted by the employer. So employer is incurring cost in terms of my absence. So that's why even for leave entitlement, you have to create a provision. Okay. Any questions in this? Great. No question means either everyone's understood everything or nobody's listening. Sorry, sir? Yes, it will not get offset, but it will get offset when I'm utilizing my leave. So let's say, for example, my leave balance was 5, which I carry forward in the next year. I'll reverse the provision. So that is offsetting in that side? Yes. Yes. Okay. Coming to some FRRB observations. Now this table I've just given different FRRB observation. First, the matter which was written in the annual report, from the note on employee benefits, the company said that it had not recognized past year's liability in respect of gratuity and leave encashment, representing liability of past years, which the company intends to account on a straight line basis over 3 years commencing from the current year. So here there's a little bit of a background. Initially the gratuity liability was not vesting only. The leave encashment liability was not vesting on the company. But once the leave encashment liability gets vesting on the company does not have an option that on straight line basis we'll start recognizing the liability. Company has to recognize the liability now. So this was a non-compliance observed by FRRB. Sorry? Correct. Yes. Then since our topic also covers significant accounting policy, these were the accounting policies which were given. I'll just let you all read. Company's liability towards gratuity in respect of directors has been provided for, not funded. Company's liability towards gratuity in respect of other employees is worked out on actual basis. So for directors, they said we don't want to do actual valuation. 1 or 2 directors, very high liability, we don't want to do. But others, we will do. Second, liability on account of leave salary has been provided for in accordance with the scheme in force. Now clearly they have not mentioned vesting, non-vesting, accumulating, non-accumulating. Then provision for gratuity has been made and is charged to statement of profit and loss. Leave encashment and other benefits are charged to revenue on accrual basis. Again, whether they have used POCM method, whether they have not used POCM method, nothing is specified. No provision has been created for gratuity liability. Gratuity will be recognized in the year of its payment. Oh. All these were obvious non-compliances. Again, I don't want to read the observation, but these were the non-compliances. I've just combined some 4 or 5 non-compliances to one. Other accounting policies, again, provision for gratuity made considering the balance sheet date as notional date of retirement, assuming that today is the last day. Growing concern, the liability क्यों create करना है? छोड़ दो. Then provision for leave encashment and gratuity are determined on estimated basis. Liability towards gratuity has been provided as per management calculation. For defined benefit scheme, gratuity cost of providing benefits is determined on actual in accordance with provisions of Gratuity Act. Again, so all these are just silly mistakes and statement where the company just does not want to understand. So many times we face this situation also, that the management just does not want to understand from accounting perspective. They don't understand that they are the preparers. First responsibility is theirs. Then responsibility is ours to audit that. So unfortunately, it is the auditor's responsibility also to explain the management whether management is being rigid to conduct actual valuation that way. Anyway, yes sir, you had some question. Accounting policy for provident fund read as follows. The company, now this provident fund policy was given in defined contribution plan. Okay. The company's contribution towards provident fund managed either by approved trust or by central government is debited to statement of profit and loss. In respect of provident fund managed by management by the approved trust, the company has an obligation to fund any shortfall on the yield of the trust investment over the administered interest rates on annual basis. Let's understand. Company is investing provident fund into two. One is which is managed by central government and which is managed by its own trust. Managed by the central government, very good, no issue. Managed by its own management, if there is a shortfall from the interest rate, the company will have to make good that shortfall liability. Clear? If there is a shortfall on the management administered fund, the company will have to make good that shortfall liability. By definition, when we understood, does this fall under defined contribution? It's a defined benefit. So sometimes this small change in the condition changes the entire classification. Then if it is defined benefit, like you all correctly said, this is defined benefit, the ultimate liability resides on the company. Tomorrow, if that management approved trust goes and gone, the company will still have to make good all the payments. So how can you call it defined contribution? And here the accounting policy was given under defined contribution plan. So it was not defined contribution, it was defined benefit, because of which the FRRB observed this as a non-compliance. So ऐसा नहीं है कि FRRB is just doing ऊपर से, that's actually seeing what is there. Okay. These were the accounting policies perspective from AS 15 and Ind AS 19. Coming to disclosures. For defined contribution plan, this has to be disclosed in your other notes. Separately, you have to disclose how much is the employer's contribution to provident fund. For defined benefit plans and other long-term benefits, which includes gratuity, leave, encashment, you have to give all these disclosures. We will go one by one. First disclosure, movement in present value of defined benefit obligation, which would be your opening, current service cost, interest cost, past service costs, benefits paid, actuarial obligation, present value of DBO at the end of the year. Okay, just one example I will give you all on this. Couple of years ago, we faced this in one of our companies. What happened was that particular company acquired another company. So all the other company ka employees now became employees of this company. When we sent the data to the actuary, the joining date of the employee was not the date of acquisition. The joining date of the employee was the original date. Okay. Now, which obviously means that if last year my liability was 1 crore, this year my liability is going to multiply because all those employees are now part of my company and I don't have to pay them gratuity from current year. I have to pay them gratuity from the original date. Now, that was the terms in the business transfer agreement. So, here obviously the actuary increased its liability. The question was, my partner had raised, the question was, where was that additional debit put? Was that debit put in current service cost? Can it be current service cost? Is it current cost? Second, could it be as part of actuarial gain or losses? So what the actuary had done, the actuary had put as part of actuarial gain losses. Now, what happens in case of Ind AS, if it is put as part of actual gains and losses, we have to put that amount in other comprehensive income. And my other comprehensive income shot up like anything. So this question was came to us. And then we did a little bit of research and we identified that whenever a company has acquired another company and such kind of transaction is there, it is not part of actual gain or loss. It is also not part of current service cost. The actuary in his report will have to give a separate line item to say on account of business transfer or addition or deletion. So on account of business transfer, we got the actuary to add a separate line, and then it was classified as part of profit and loss account, but it was part of acquisition, not because of current service cost. That way. Now, obviously, if you see the statement of profit and loss in isolation, you will see that P&L has gone up. But in the disclosures, you will be able to identify that on account of business transfer, it has separately come. It is not actual gain or losses. There has been no change in assumptions because of which the liability went up. Okay, so just an example. Another disclosure is the movement of fair value. Now, this company did not have fair value assets, but fair value asset movement you have to give. Amount recognized in the balance sheet, liability less fair value of plan assets or fair value of plan assets less liability, whichever way. Amount recognized in statement of profit and loss. Here, and additionally, amount recognized in OCI will come if it is Ind AS perspective. Sensitivity analysis. If there is an increase or decrease in the assumption rate, then what would be your liability? And the actual assumptions which are given. These are the disclosures, or these are the kinds of disclosures which need to be given for gratuity as well as leave encashment if the company is not an SMC, or if the company is an SMC with more than 50 employees. So if you are an SMC with less than 50 employees, you don't have to give all these disclosures. If you're an SMC with less than 50 employees, you can just give your closing liability and amount recognized in the P&L and the principal assumptions used. That's it. You don't have to give all the tables. So that is a specific, exemption given to SMCs. For Ind AS, it goes one step extra, where whatever the types of risks are there, you give your change in assumption also, but whatever are the different types of risk, you have to give narrative disclosures as well. Okay, any questions till here? Great. Again, significant accounting policies for employee benefits are divided into short-term employee benefits and post-employment benefits. Short-term employee benefits could be your salaries, wages, bonus, etc. Post-employment benefits could be, again, bifurcated into defined contribution plan, defined benefit plan, and other long-term employee benefits. If the company has share-based payments, separately you can add share-based payments as well. Now, this was the defined benefit plan for regular accounting standard, where everything they say will be debited to profit and loss, etc. Oh, sorry. This is for the Ind AS perspective, where they said remeasurements on the net defined benefit liability comprising of actuarial gains, return on assets are recognized in OCI, other comprehensive income. So please ensure that if you're converting from AS to Ind AS, this distinction is there. You have to change the accounting policy as well. We have time? We have time. Okay. Separately, additional information, a company shall disclose by way of notes additional information regarding aggregate expenditure and income on following item: employee benefit expense, showing separately salary and wages, contribution to provident and other funds. So one first defined contribution we saw in the other notes, we had to give this. As part of your other notes, you have to give how much the employer has contributed. But when you have the note for employee benefit expenses, in that note also, you have to separately show salary, which will include basic, etc., and contribution to employer funds, etc., has to be shown separately. Contribution of employers. So that distinction, please remember, two places contribution of employers to funds will come. Okay, this just on a lighter note. The tiers of which jar will be more full? The tiers of accountant because they have to prepare the financials, or tiers of auditor because they have to verify the financials? I believe tiers of auditor, because we'll also have to tell the accountant to do this, please. Okay. Sorry? Always the auditor. Okay. Okay, coming to the next one very quickly. AS3, cash flow statements, and Ind AS 7, both I'm taking up together only. These are the FRRB observations, what they have observed in pertaining to what areas. I've just compiled a small table. Repayment of external commercial borrowings. So if we see the matter, in the cash flow statement, certain amount was reported as repayment under the head cash flow from financing activities, which is correct. Repayment of loan is cash flow from financing. It was noted that the balance of ECB is reduced from previous year to current year. But the balance of ECB reduced from previous year to current year, not because of actual repayment, because of liability write back. Still in the cash flow statement, they had not considered that only, and they just reduced last year to current year ka difference. Instead of profit and loss, like when you start from profit before tax, you subtract non-cash income. So they did not do that. They had shown this way. So this was a non-compliance found. Taxes on income, again, in the taxes on income, what they had done, they had basically taken the provision amount as deduction of taxes paid. Whereas in reality, you have to take the actual taxes paid as deductions from cash flow from operating activity. Okay. Gratuity and other comprehensive income. Generally, when you start the cash flow statement, we start from profit before tax, which is before comprehensive income. Correct? So whenever if you are adding back the gratuity which is debited to profit and loss, do you also add back the gratuity which is debited in other comprehensive income? No, because the starting point is profit before tax, not considering other comprehensive income. So whatever is the actual gain or loss of gratuity, this particular company, they had added the P&L effect also, they had added back the OCI impact also. So which means somewhere else they would have adjusted the difference. Foreign exchange fluctuations. Contradictory figures were reported for foreign exchange fluctuations in the cash flow statement vis-a-vis note forming part of the accounts. So whatever was the foreign exchange gain loss, the different figures were given in P&L notes and different figures were given in the cash flow statement. Disclosure for changes in liability from financing activity. Relevant abstract from cash flow statement showed as follows. If you see, cash flow from financing activity and interest accrued was separately shown. It was viewed that there had not been any actual cash flow, but mere increase in accumulated interest payable on borrowings, which is a non-cash transaction, but which they showed as increase in borrowings as cash inflow. but that was wrong. It was just accrued interest, which was not supposed to be increased. Cash flow disclosure to be made on gross basis. Proceeds from borrowings. Again, this is a very, very common mistake. Proceeds from borrowings cannot be shown on net basis. It has to be shown on gross. Amount received alag se, amount repaid alag se. You cannot net it off and show it. Non-compliance. Cash advances and loans given to other parties. Cash advances and loans to other parties were disclosed under cash flow from operating activity. When can cash advance and loan given be cash flow from operating activity? Only if the company is a financing company. Then for them it is their regular operation. But if the company is other than financing company, then it has, for advances given and all, becomes an investing or financing activity. Okay. Capital advance. You know how we prepare cash flow statement. If we have ever prepared, balance sheet में सब notes का differences ले लो, वो notes को put it as adjustment of working capital and P&L से whatever you know just add back. Same thing they did. Even capital advance difference they took, other long-term loans and advances, capital advance ka difference they took, they put it in changes in working capital. You give capital advance for purchasing an investment, purchasing an asset. So it is obviously cash flow from investing activities. But they showed changes in movement in capital advance as part of operating, changes in working capital. Such like, small, when we look at it, when, looking back at this, it seems to be so basic. But when we are actually looking at the financial statement, I wonder sometimes, do we actually look at all these things or no? And another observation was from the cash flow of a financial company. It was noted that the following items were disclosed as financing activities. So loan repayment, loan disbursed. If it is a financing company, it should be part of your operating activities. From the annual report of a company, it was noted that it was a subsidiary of a listed company. However, cash flow statement was not prepared as part of its financial statement on the ground that it is an SMC. If the company is a subsidiary of a company which is not an SMC, automatically it is not an SMC. So cash flow will become applicable. Sorry. This talks about earmarked funds. If the funds have been earmarked for any particular purpose, then in the notes to cash and cash equivalents you have to give. But in cash flow statement also you have to separately disclose that these funds, out of this cash balance, this much balance has been earmarked. So this was not done. Okay. Any questions in AS3 and AS15? Great. AS22, let us take up. AS22, Ind AS 12, again, Ind AS 12 gives some extra disclosures which we are supposed to prepare. We will see what are those disclosures. Yes, sir. No problem. Parked into the There was no cash inflow. No, so see, you will not add it. You will add it back in your cash flow statement because it is a non-cash expense. Both cancel out each other. So what we do for such kind of situation, even any debt restructuring also, sometimes when it happens, we separately show below the cash flow statement. We create a table to show that this movement has happened. Yes. Yes, and then we show this disclosure separately. We do take a similar stand even in case of sometimes forex restatement also. That way. So separately below the cash flow statement, you can show a note, show a small table. Okay. Coming to AS22, Ind AS 12. One of the observation in the annual report, net deferred tax liabilities asset was disclosed as follows. deferred tax asset on account of so and so, deferred tax liability on account of depreciation, and on account of others. Others, as per what FRRB observed, others was a material amount. So you have to disclose the nature of others. You cannot just say on account of others. So what was the nature of that others company had not disclosed. So they found a non-compliance. From the statement of profit and loss, it was noted that provision for taxation was shown as appropriation of net profit. Rookie thing. Provision for tax was shown not PBT but appropriations, and in an appropriations you showed provision for tax. Provision for tax is not an appropriation of profit. It is your liability, contractual liability, which you're supposed to pay. In the annual report of a company, note on deferred tax liability was stated as under DTL total as per balance sheet of last year. So in the current year, you cannot say as per last year. You have to still give a breakup of what all were included in the deferred tax liability. Okay, accounting policy, since we are here, so let us look at accounting policy also. In accordance with AS 22, accounting for taxes on income, the deferred tax for timing difference is measured using the tax rates and tax laws that have been substantially enacted at the balance sheet date. Deferred tax asset arising from timing difference are recognized only on the consideration of prudence. Not incorrect, but incomplete. Deferred tax asset has to be recognized when there is reasonable certainty that the company is going to have future taxable profits against which those set off the asset. Correct? So those additional lines were missing, because of which they said that they found a non-compliance. So you have to clearly put in the significant accounting policies when you are recognizing, when you are not. You cannot be cut short and say that we will recognize on consideration of prudence. That way. Again, as per Ind AS 12, now coming to disclosures, additional disclosures which are there in the Ind AS, the aggregate amount of current and deferred tax, you have to give the amount of income tax to each component of OCI separately. This is not there in accounting standard. For each component which you are putting in OCI separately, you have to give the income tax component for it. And an explanation of the relationship between tax expense and accounting profit in either or the following manner. A numerical reconciliation between tax expense and the product of accounting profit multiplied by applicable tax rate. So how we do a cross check separately in case of normal companies, we do a separate cross check. If my effective tax rate is 25.168%, then how much taxation I'm getting, and then we do a reconciliation. In Ind AS, you have to show it as part of your notes. So let us see how. This is an example. The tax expense of current year was this much, and then you have to give a reconciliation. What was the profit before tax? Had you applied the effective tax rate, you should have got 11.609. But because of the tax effect of disallowed expense, additional allowances, your net current tax provision came to this. On that, incremental deferred tax liability and impact of tax change rate, the difference was so much, because of which the deferred tax provision was this. So net amount from 11,600 became 10,866, giving the effective tax rate of 23.56. So this reconciliation has to be given in Ind AS 12. Okay, that's it for Ind AS 12. Coming to AS 1 and Ind AS 1, disclosure of accounting policies and presentation of financial statements. Here, whenever we see the major non-compliances or the major issues which had come was in the framing of accounting policies. So many companies, what they used to do is, so for example, if you see here, impairment losses on, if any, on fixed assets have been recognized in accordance with AS 28. Intangible assets are recognized in accordance with AS 26. Deferred tax liability provided as per AS 22. Subsidies granted so and so, so and so. They were just mentioning that it has been accounted as per this particular index, as per this particular index. That is not what the accounting standard tells you. As per every different accounting standard, you are supposed to have a different accounting policy. So that has to be disclosed. And one more thing which AS1 says, which rarely is missing, but is missing. All the accounting policies shall be disclosed and shall be disclosed in one place. you cannot have accounting policy for employee benefits below employee benefits, accounting policy for PPE below property, plant and equipment, accounting policy for conversion cost forex below forex note. All the accounting policies have to be disclosed, and they have to be disclosed in one place. These are the words of AS1, because of which we disclose all the accounting policies in one place only. Okay. So this was one of the abstract of Ind AS 1 presentation of financial statement. Again, this is one FRRB observation. In case of Ind AS, this is how they are disclosed. P&L from continuing, profit for the period, earnings per share, direct. What did they miss out? Other comprehensive income. They had not shown only distinction between profit and loss and other comprehensive income. So that they had missed out in Ind AS financials. So this was again one of the non-compliances. Okay. Yeah. Material uncertainty relating to going concern. Now this particular entity had a material uncertainty. So what it disclosed in its financial statements? In preparing the financial statements, management has made an assessment of the company's ability to continue as a going concern. Financial statements are prepared on going concern basis. The management is aware in making its assessment of material uncertainty. In making its assessment, management is aware of material uncertainties related to events or conditions that may cast. They said, we are management, we are aware of the material uncertainties. What about the reader? So as part of management, you are not supposed to know what are the material uncertainties. You are supposed to disclose in the notes that what are the material uncertainties. They just said we are aware. But you have to disclose that kya tha material uncertainty. Okay? So that was the non-compliance observed by FRRB. I'm reaching there. Okay, so this, I just wanted to take a few accounting standards, accounting standards and Ind AS. So I've taken few accounting standards and Ind AS. We'll skip Ind AS 115 because it will become very technical. I would like to instead show you some disclosures which are there as per accounting standards and other disclosures which come. So as per AS 20, whenever there is an exceptional item in the profit and loss account, earnings before tax has to be bifurcated. You have to show two earnings before tax. Earnings before exceptional items net of tax and earnings per equity share, both basic and diluted. So there is a paragraph in AS 20 which says that at any point of time when the company has exceptional item or extraordinary item, then the effect on the earnings before exceptional items and after exceptional items both has to be shown. Okay, but before exceptional items, net of tax. And here also, I'll just tell you, there was some FRRB observation. Here, how we have mentioned the nominal value of the share, that is also mandatorily supposed to be mentioned. So some companies had not mentioned nominal value of the share. Some companies said diluted EPS, not applicable. When there is no dilution, basic EPS is the same as diluted EPS. You cannot say diluted EPS NA. Okay. Again, disclosure under IGAAP. This was the disclosure on the face of balance sheet, and this was the disclosure in the notes to accounts, same balance sheet, where you have to give the total number of shares also, earnings, profit that you have considered before exceptional items net of tax, and profit that you have considered for the year, and then earnings per share in both basic and diluted. Significant accounting policies, again this is a standard policy, no issue. If you look at the FRRB observation, basic and diluted EPS not disclosed on the face of profit and loss. Notes made was disclosed, but face made was not disclosed, non-compliance. Diluted EPS reported as not applicable, like I said. The nominal value of shares has been disclosed only on the face of statement of profit and loss and not in the note giving computation. So you have to disclose on both places. Although statement of profit and loss showed exceptional extraordinary item, the computation of basic and diluted EPS was made with the profit after tax inclusive of exceptional and extraordinary. They did not bifurcate. And the statement of profit and loss and note on EPS in the annual report of a company indicate that since it had incurred loss during the year, EPS was nil. Very good. Okay. additional disclosures which are given, which are supposed to be given. So these are some additional disclosures which are supposed to be given as per Companies Act Schedule 3. Unhedged foreign currency exposure. Whenever a company has foreign currency exposure, whatever is the closing foreign currency and closing rupees, we have to disclose in the financial statements in other notes for current year as well as last year. Value of imports, again, additional regulatory requirement from Schedule 3. Whenever a company has imported goods, value of imports on CIF basis has to be disclosed. It can be imports of goods also, it can be import of PP, whatever you have imported. MSME, again, this MSME disclosure note comes in the financial statement, not from Companies Act, but this comes from MSMED Act. Okay. Leases comes from AS 19. As part of AS 19, future minimum lease payment for non-cancelable period has to be bifurcated into not later than 1 year, 1 to 5 years, and more than 5 years. This has to be disclosed in the notes to accounts as per AS 19. I think that's it from my side. Thank you everyone for your patience for listening. And I hope this was useful and we can apply this. Thank you.